year ago, there was no shortages of challenges for the fixed income market. I mean, you were looking at rates worries, inflation worries, recession worries. So, people were talking about stagflation and things like that. And it's not surprising that you've seen across fixed income market, but also across other markets, some pretty high levels of volatility and negative returns in 2022. 2023 is, proving to be a better environment. You've got those recession fears of abating. People talking about a soft landing and central banks actually being able to pull that out of the bag. Really, you've got a strong earnings compared to expectations. You're seeing, a very strong job markets in the U.S. So all of that seems to be pointing to a much more supportive environment. And so if you look at the performance of asset classes, I mean, last year, US equities were down 18%, US loans were down probably around 1%. Now, since the first 6 months of the year, what you've seen is loans are about up 6% and equities were 17%. So a very different environment. Now, having said that, when we look at what's happening out there, I think we still feel that volatility is going to be a theme of the market because of the uncertainty. Because while earnings have been better, the forward guidance is still pretty soft. Because what you will see is that the impact of higher interest rates is going to start to really impact some of those corporates, and you've started seeing defaults increasing. And therefore, when we look at that environment, we're thinking, again, security selection is going to be absolutely crucial, and trying to really try and dampen that volatility is going to be crucial to outperform. If you look at fixed income and the themes out there, obviously the higher level of volatility from the uncertainty around rates, inflation, we're seeing that this year into 2023. You basically are in this environment where one day you're getting some pretty positive numbers coming out on jobs, on inflation, and markets move one way or another. So it's very short burst of volatilities that we're seeing in markets. The other things that we think are going to be key themes going forward, again, is the fact that with those higher rates, you're going to start to see defaults increasing in markets. And so our expectations is that for leveraged loans and high yield bonds, coming off a very low base of defaults, you're going to start seeing them going back to historical averages of 2.5%, 3.5%, 4.5%, which is again in line with historical averages. What we're seeing as well is that we don't expect those defaults to spike much higher than that, because we basically just had a cycle where corporates refinanced in 2020, pushed out their maturities, have quite good interest cover ratios, so the starting point is pretty strong. But clearly, what we're going to see is that corporates that have over-levered, that have overstretched, that are in sectors that are challenged, we expect to see some more dispersion between those credits across the market. So default rates, we do expect them to increase versus where they have been. We've been in a situation where default rates have been extremely low. And what we're seeing right now is that our expectation is that probably in the next 12 months, we'll see them increase again to around 3.5% to 4.5% of the market. Again, this is in line with historical averages. We don't expect to see them going back to the levels that we've seen during the GFC, which for loans were around, just above 10%, and for high yield bonds more around 20%. And really, the starting point and why we believe that this is not going to be the case is when you look at the fundamentals of those corporates, when you look at what they've done since 2020, is that they've refinanced themselves, they've pushed out the maturities of their debt. So you don't really have a wall of maturity coming at you that would push those defaults much higher. When you look at the second reason why generally corporates default is they cannot service their debt. You look at their serviceability level, while they've actually softened a little bit recently because of higher rates, we're starting at very good levels compared to historical levels. So it doesn't really support the view of a default cycle where you would see 10+% defaults in those markets for the next 12 months. In terms of the risk, we've talked about this. I think if you look at the uncertainty around rates and the potential volatility with longer duration assets, that is something that we're very conscious about. So we're not pushing our portfolio very much further in terms of the duration risk spectrum. Again, the Ares Global Credit Income Fund, we've got about a year of duration, a bit less than that. We're starting to buy fixed rate assets that are heavily discounted because of the fact that they're fixed rate, and so they've sold off quite significantly. So high yield bonds, single Bs trading at 90 cents on the dollars. It's a pretty attractive proposition if you do your credit work and you can see that it's a corporate or a bond that should not default. So at maturity, you should get par back. There is a lot of convexity there. And there's also a lot of optionality because those corporate bonds tend to be repaid before their maturity. If there is a corporate action like an acquisition, for example, then they would get taken out at par. So there's a lot of optionality there. We like that. We also really like shorter dated loans with high levels of current yield because if they're shorter dated, the price volatility is mitigated. They have high levels of current yield, so you're getting very attractive levels of current income. So these are things that we really like. But again, what is going to be key in our view is credit security selection because of those rising default risks, and also the fact that for corporates that miss their earnings, they tend to be punished. Their loans, their bonds tend to be punished from a price perspective in the secondary market. And so that would add volatility to a portfolio if you did select corporates that weren't performing as expected from a credit standpoint.